Hello, everyone. Again, good morning and welcome to Saxo's weekly market outlook call. I'm Charu Chanana. I'm a market strategist with Saxo Singapore, and I'm joined today by my colleagues from Sydney, Jessica Amir, and from Hong Kong, Redmond Wong. So we are starting a very busy week today. Yes, we will be busier than Santa this week. A lot of tier one data, central bank meetings lined up for this week. So we can say that there will be a lot of volatility as well. Let's dig right in and find out what really to expect. But just stepping back a little bit first, let me start with a quick recap from last week. We had somewhat range-bound markets last week as we probably waited for the big week that we have upon us now. But also because Fed was in a blackout period and coupled with some thin liquidity before the holiday season really kicks in. We started the week on a down note following a significant upside surprise in the ISM services index. So that kind of defied expectations for a small decrease and rose to 56.5, which was near its highs over the past several months. And then towards the end of the week, we had another positive surprise from US PPI release for November, which was also higher than expected, up 7.4% year on year versus consensus expectations of 7.2. While the PPI data continued to show that there is a peak in inflation in YOY terms, but the downward surprise is still pretty limited, we think, and it may not really be enough to support those Fed pivot expectations that investors are, really holding their breath for. Still, the impact was a little bit short-lived, but PPI prints usually do not have an impact on the market. It was just because it was a week where there was not enough data. We are heading into the CPI and the FOMC week that it kind of generated the response that it did, but it's still not an all-important release for the markets if you look at it from a broad sense. But this week is different. We do have, like I've mentioned already, a lot of key releases. US CPI, we have the FOMC decision as well. So November CPI is expected to soften, but the question really is that will it soften enough? So last month, when we had the October CPI, it was really the turning point in the markets, and inflation expectations did turn markedly lower. Consensus is looking for another softer report in November. Headline expectations are for about 7.3% YOY from 7.7% last month, while the core is still expected to be a lot more steady at 6.1% YOY from 6.3% last month. No doubt, we do have a case for a softer print. We have lower energy prices, supply chain pressures are easing. We've had holiday discounts, from retailers to clear their inventories. But still, I think it won't be enough to call for a Fed pivot again, especially because shelter costs are still rising. ISM services still indicated that we are not getting a marked slowdown in prices as well. And then the very next day, the focus shifts to FOMC on Wednesday precisely, where again, we have been saying that smaller rate hike is what is expected. So 50 basis points is what is priced in for the Fed, unless we see a very big positive surprise in the CPI. But that's 50 basis points is what we will likely get this week. We will be getting the updated dot plot as well. And that too, again, it has been said by Powell himself that it will likely see an upward readjustment. So, the range that we've talked about of late is that we could see the terminal rate forecast going up from 4.6%, which was set in the September dot plot, to a range of 5 to 5.25%. So what we really need is something more than 5.25% to really constitute a positive surprise. And the other thing, of course, to watch is can we get enough pushback on those rate cut expectations that are priced in for 2023. Financial conditions have been easing up until the previous week. The last week was obviously a little bit tighter, but until the week before that. And that's also something the Fed would worry about. There's also the China reopening story, which we will again get to in a few minutes from now. It is happening a lot faster than expected, and more stimulus can be expected also in China, as the focus is turning towards growth. So that could mean another run higher in commodity prices as well. So Fed is cautious of premature easing. So once again, while there is limited room for surprise on that rate decision, the key to watch will be the dot plot and Powell's press conference. But I'll pause here now. I think, Jess, you've been also watching how S&P and NASDAQ respond to US CPI prints. Maybe you want to discuss that and what to expect this week.
Yeah, thanks, Charu. So I think we need to keep in mind why we're thinking the volatility could pick up. And if we just think about the previous years, or even more near term, the last 6 months reads, we saw the S&P 500 jump 3% on the day the inflationary read came out. So that is something that we are considering. So a 3% move historically on the upside, or inversely a 3% move on the downside. So this is what's happened over the past 6 months when you look at inflation on the day that the CPI read came out. We also need to consider as well, the S&P 500 has fallen 7 out of the 11 CPI reporting days. So I think despite what we said about the producer price index, I just explaining what that is. It's a measure or a gauge of wholesale prices. So that came out stronger than expected on Friday. And that's why we saw also equities take a haircut, and also bond yields pushed up. So a similar scenario might potentially play out if we don't see inflation fall to 7.3% year on year as expected, down from the 7.7%. So that's something to consider. What are we saying here? We could potentially see equities sold off if the inflationary print is hotter than expected, because that would give the Fed more ammunition to stay the course and keep rates higher for longer. Speaking about higher for longer, as we mentioned, the forward-looking commentary will be gleaned or gone through with a fine-tooth comb. The market is now expecting interest rates in the US to peak in May next year before being aggressively cut. So I guess we'll be looking for commentary in that, but that'll be interesting to see. But all in all, bracing for volatility is key. Potential pickup in the USD and sell-off in the equity component of the S&P 500 and the NASDAQ as well, if we do get a higher than expected read. Inversely, the opposite case. But yeah. Eco, that's our team specialist, Charu. So unless you have something to add on that.
All good, but maybe we should talk a little bit about the yields as well. I think 10-year yields did take a trip down to below 3.5%, in fact, last week, which was a key support level. But then again, they've ended the week pretty much unchanged. Redmond, maybe you want to touch upon what we can expect in terms of the yield curve movements, especially with all this data and central bank meetings lined up this week.
Yeah, I mean, bond has a very strong rally with, as you mentioned, 10-year yield. Last week, once dropped to 347 cuff level, below the 350 technical support. But of course, it's on Friday, after the PPI print, it jumped 10 basis points all the way back to close at 358, now trading around 389. I think one thing, we just step back a little bit. I think as you probably can see in Steen's interview on CNBC, and we are not calling for a recession in the US, at least not anytime soon. And the market, we think that currently those are calling market expectation of a very sharp US recession very soon in the first quarter, second quarter will be premature. And and what would that translate into yield? And yeah, I mean, I also want to add to that. We also think that's the inflation will be quite sticky. I mean, probably may have, is the rate of changes, the second derivative may have come down, but inflation rates themselves are still quite high and not coming down anytime soon. Especially as Charles mentioned, the shelter still going up, but even as shelter service, shelter costs, maybe when those leases being renewed, and if they slow down, there's actually another component. Also, Powell is watching very closely. That one has not really meaningful come down yet. Is the surface core surface PCE excluding housing, and that is mainly driven by wages. And looking at the wage data from the average hours earnings and so on, that means basically there's very little improvement from the wages and also the surface cost PCE surface X housing component. And both actually Powell emphasized in his speech at Brookings institutions on November 30th. And and what does it mean translate to you then is if now it's a 3-month T-bill yielding at 4.21, and the 2-year now, even though after the bounce in Friday, is yielding only 4.36, unless historically, unless the market, unless the Fed is will pause or start cutting rates soon, it's very difficult. Actually, it has, over the last 20-30 years, never really for the 2-year to go below that 3-month T-bill yields without forecasting a rate cut. So, is our position, I will that the Fed is not going to cut rates anytime soon, that they are not even going to pause. They will slow down, downshift the magnitude of the rate hike, but not stopping. So that means is that the 2-year yield basically, we have been bullish on Treasury, and we also bullish for Treasury over next year. But for think that it's a good asset to be held in a portfolio, but at this current yield level, probably I think we would rather call for patience. And at 4.36, a 2-year, there's actually little juice left for short term. And as it's very difficult for it, as we said, it's very difficult unless the Fed is cutting rates, it's not going to go below the 3-month T-bill yield. And on the yield curve, and the yield curve, we steepen a little bit, 210 to 76 basis points, but still really inverted. And that's also one of the reasons why investors are saying that are expecting a recession in the US, because the yield curve, both the 3-month to 10-year and also the 210 providing this kind of signal. But with the 2-year anchor and the volatility actually quite high. If you look at the MOVE index, that's the Empire War Index on Treasury yield, bounced back to 133 level on Friday. And the reason, for the curve and term premium, i.e., you need to be compensated for the risk for owning longer term securities. So that means is unless really there's a recession very harsh coming, and the curve is too inverted, and the term premium is too negative, and so there's also some risk on the 10-year at this level, especially once it tests and went below the 350 technical level, now bounce back and close above it, and there's also a chance for Treasury yield to first go up. And for investors who would like to position for portfolio, including some bond, we think that's a good idea for next year. And I think we can pick for better level, and probably we can expect the 10-year go above 4% again, and then we can we can start accumulating from there rather than jumping in right now. As we discussed last week, some of the tips, those the inflation and protected bond may be interesting. I think that's all I want to say about bonds.
Thanks, Redmond. Some great points there about, we don't expect a recession next year, or at least it will be a mild to moderate recession, not a steep recession in the US. Also, just to add, we don't think the Fed will cut rates as well. I think it's premature to expect them to start cutting rates. Next year, at some point, we have to shift the narrative from where is the peak in inflation to really where is the floor and how soon we can get there. And that's not really sending signals that Fed could start to ease next year. We expect, of course, 50 basis points this week, but then maybe another 50 basis points early next year, a few 25 basis points to get to the terminal rate, and then we expect the Fed to pause there. So of course, given what Redmond said about how you can really construct a portfolio going into next year, add some bonds, I think that will be really interesting to consider. But just switching gears here, we also have other key central bank meetings this week, specifically the ECB and the Bank of England as well. And a downshift in rate hike trajectory is actually expected across the board, but it will unlikely be as unanimous for ECB, for BOE, as it will probably be for the Fed. Inflationary pressures have been more persistent in Europe and in the UK as well. Winter months are coming in, energy prices are also rising again, and we also have more pronounced economic pressures. So that kind of explains why there will potentially be a wider split, members voting for smaller as well as for bigger rate hikes as well. For UK particularly, we also have a host of data in the run up to that BOE decision on Thursday. We have headline CPI, which is again likely to soften. Again, although that relief may not last into 2023, and core measure is still firm as well. There are wage pressures as well. So overall, I think with that 50 basis points hike kind of priced in for the Bank of England, sterling may not have that much of an impact. For the ECB, we could still potentially get another jumbo rate hike. We've seen some positive data. Last week, the GDP report was better than expected. So again, euro dollar remains the key to watch. 1.06 resistance is already, it's being tested, and there's potential. If that breaks, we could extend the uptrend to 1.08 as well. But I said this last week, and I'll just repeat myself, euro is looking overbought at this stage. And just very briefly on USD yen as well, I think we will be watching a reversal above at least 139 to really suggest that we've reversed that short-term sell-off that we've seen recently. We have already seen that in some of the other yen crosses like euro yen, sterling yen. They've seen stronger reversals, but USD yen, I think we're still waiting for it to kind of go back above 139. But let's switch to China. Of course, that is the big other big story for the markets. Redmond, can we expect this reopening momentum to continue despite probably a set of weaker activity data being released this week?
Yeah, I think yes. I mean, the momentums in the reopening actually has picked up quite fast, and we think that is going to be able to sustain. So that's for sure. This is a major policy shift there, and the latest actually the top health official. Experts also say just came out. I say that the fatality and the death rate is for Omicron variant is just like flu. So they're going to continue to downplay and prepare for the population to get ready for more this relaxation. Yes, the momentum going and continue, and I think also in the investor communities and also analysts many of them have upgraded now the outlook for China for next year, and as we have also done it earlier. And I think because there's still, previously there was still a lot underway, so there would be the buying probably can have some way to go. But of course, it's initially people will be focusing on all those high beta kind of stock. But when it's at this stage, maybe we can start looking at some other more individual stock and just away from just focusing on the high beta setup. And also, you mentioned about the real activity data, the activity data coming out in China this week. Yes, they will be expected to be weak because of they still cover the period in early November. That is it's quite a lot locked down at that time in China. I think the market will not pay too much attention to it. It's going to look through it. I think that the important thing really for this week will be the Central Economic Work Conference of the Chinese Communist Party. And last week they had the Politburo meeting, basically to set the tune and prepare for this meeting. And this meeting is a Central Economic Work Conference. It's an annual meeting. It's every year. It's mid December or second half of December. And this time I think it's expected to be held this week after presidency came back. Because he's back now to China, and from his trip to Saudi Arabia. And I think the key thing is that there will not be much surprise about the COVID situation. Anyway, the agenda is not really on health or pandemic controls or macroeconomic policy, but they probably will. So there probably will not be much surprise. I think the investor will be watching more closely on properties. And because in the Politburo meeting, in the readout, in the memo coming out from the meeting, it did not say they did not repeat the housing is for living in, not for speculation. They omit this rhetoric, and they have been doing as in the last few meetings and also in other occasions. So I think investors will be analysts will be watching very closely what actually they will say about how much support they are going to give to the property sector, or whether they will uplift, remove the free red line that is preventing developers to over leverage and all those policies. And then also we'll be watching closely about what they say about private enterprises, the balance between SOE and private enterprises, and also tech sector. I think those will be more because in the Politburo meeting readout, they basically maintain their rhetoric about the SOE will be the dominant, and the Communist Party will have the leading role in all the economic activities and so on. And so I think market will look for any other additional what they say about the tech regulations over the tech sector and also private enterprises. And I think those will be more important, because COVID, I think pretty much is a consensus already. So we'll be looking for some other thing. And one thing, they will not put up a specific numbers or targets for the economy, because that will be the job for the March national people Congress, but they will set the framework and policy and directions for next year, for the macroeconomic policy next year. I think that's the most important thing to watch in China this week.
Right, great. Okay, just a quick note on commodities as well. We did see oil prices plunging sharply lower last week, despite that Russian price cap, because focus is so much more being on recession concerns and global slowdown. We could see potentially a lot more volatility again this week. We have key data, of course, CPI and the Fed meeting as well, but also Russian response to that price cap is awaited. They have been threatening of production cuts and the likes. So let's see what we get. But let's touch upon some of the other commodities, maybe with Jessica as well. Jess, what's on your radar in the commodity space, and of course, specifically for Australia as well this week?
Yeah, good question, Charu. I will just say on equities broadly, we just need to be mindful that the S&P 500 and the NASDAQ are looking potentially that they may see a pullback. So we've mentioned volatility a lot. And then we've also mentioned in, as Charu and Redmond said, why as a house we think the Fed will keep interest rates high for longer. I think it's really important to note what I said earlier about the market has priced in, as I said, that interest rates will peak next year and then aggressively be cut. So why we think that markets could potentially see another pullback is because the market has priced in that interest rates will be cut, but we don't think that that may be the case. If we get commentary from the Fed this week that interest rates may stay high for longer, then you could see more of a broad sell-off. So that's really important to mention, that absolutely critical. So just be mindful that is what we're talking about, why we could see this extra pressure in equities if inflation is indeed higher than expected. Speaking about commodities, of course, we've got iron ore price, which has been in an uptrend. So the iron ore price has been benefiting from 5 key cities being or having their restrictions eased in China, as well as China dangling the carrot that restrictions could ease further. So that's caused the iron ore price to rally significantly, and that supported the big miners like BHP, Rio Tinto, Fortescue Metals, Champion Iron. So their shares are up 25 to 55%. But I mentioned in a note last week why I think the iron ore price will pull back, and it started that pullback it looks like it could potentially be the beginning of a broader pullback here today. And the reason that I mentioned that on Friday was because I saw that volume was starting to slow down in buying. And the reason the market is now considering taking some profits off the table is because there's concern that China's steel mills could actually close earlier than expected ahead of China's Lunar New Year, which we know is the beginning of the new year. But typically, we do see restocking occur before the Lunar New Year. But what I'm saying is I think that there's going to be volatility pickup in iron ore, so potentially selling in iron ore and also profit taking in those key iron ore stocks that I mentioned. And also there's a risk that China's steel mills could close earlier than anticipated because of a softening of demand, because their restrictions have I guess, dampened consumer confidence there. That being said, we have seen just ending on equities more broadly. If you have a look at our Saxo equity baskets, stocks exposed to China that you can find in our China consumer and technology basket, they have seen the most rallies this month to date across all the Saxo equity baskets that we track. So the China consumer and technology basket is up about 8%. Also stocks, keep in mind, internet stocks that are doing really well on the back of this notion that they've got a policy, as Redmond said, supportive policy. And potentially dangling the carrot that that there could be some further encouragement for the consumer there. As such, we are seeing consumer stocks do well, like JD.com, but more alarmingly, Chinese internet stocks like Baidu, Pinduoduo, they're up 5% and 4% last week. And again, that's a broad reopening notion. So on one hand, as we made it really evidently clear, you've got the Fed and the R word driving markets, and lastly, China. But I think I'll leave it there because I spoke for way too long, but some really critical points that I had to mention.
Just one quick point is just be careful that in that the Central Economic Work Conference and the Chinese authority may be a little bit harsh still will be on the tech sector and the private enterprises. That would be a risk. We need to be careful.
So potential, volatility. That's really good that you mentioned that, Redmond.
Yeah, thank you both. So yeah, well, there's a lot more we want to discuss today, from geopolitical tensions to earnings expected this week. But in the interest of time, probably we'll stop here, and you can find all of that in our Saxo Spotlight note on the platform, which will be published in maybe an hour from now. And you will also have the option to replay this call. Lastly, I think I would just want to mention about our outrageous predictions, which we launched last week. If you want to really stimulate your thinking, we have some big ideas for you for next year, and these are not our baseline forecast. Then nothing in the baseline really ever brings big moves in your portfolio. So do give it a read. I'm sure you will enjoy that. We've discussed a lot of brilliant ideas like USD yen potentially getting capped at 200, potential meat ban by a country, a possible new reserve is set to replace the US dollar as well, among others, of course. We also have a webinar scheduled to discuss these predictions this week on Wednesday. Do sign up for that as well. But that will be it from all of us today. Thank you for tuning in. Have a good day, good week, everyone. Bye-bye.
Bye.